Hi there, it's Chris here again from the Hampstead Property Blog. Now this episode is answering the questions to last week's episode on inheritance tax, and we've had quite a number of people call and email the office regarding the new rules that have been phased in from April of this year, and many people have been calling us concerned about the changes and how they affect them. So in this episode, we're looking to explore some of these questions and the answers, of course, which I'd like to share with you. Firstly, people have been asking, how do I know if I'm eligible for the exemption? Now, to qualify for the Residence Nil Rate Band, which is the RNRB, you must declare a property as part of your estate. This must have been occupied by you as your main residence and at some point in your lifetime. If the property was always let out, then it will not qualify under the new rules. Who can inherit? As mentioned in last week's article, it's only the direct descendants of the owner, that is children, grandchildren and stepchildren. Other relatives such as brothers, sisters, nieces or nephews, for example, will not benefit from the RNRB. Likewise, single persons without children will also fall into this category. What if the property is left in a trust? Now, under the revised rules, property that has been left in trust will not qualify for the residential nil rate band. In essence, the beneficiary will be the trust, not the direct descendants. Can part of the allowance be used by me or my spouse? Well, in short, the answer to this question is yes. Either spouse can pass on any of the unused allowance on their passing. The unused amount can be added to surviving spouse's estate, or on his or her death, this will be calculated against any current rate and used to lower any liability. Can I reduce my tax liability on my death? Now, during your lifetime, you're allowed to give away your wealth in the form of small gifts up to say £3,000 before you're liable for any tax. However, there is something known as potentially exempt transfers or PETs. Now, in the event that you give away a big asset like your house, provided that you're still living within 7 years of making the gift, this asset will be exempted from tax and it will be removed from the value of your estate. A woman recently emailed me asking me about her husband's estate, which she inherited tax-free some years ago. Now, the combined value of the husband's estate and hers was now worth over £2 million, and she wanted to know whether or not she could avoid the clawback. Now, in cases where the surviving spouse has an estate that will essentially exceed his or her and the deceased spouse's allowances, the remedy is to use the potentially exempt transfer rule, or PETs. In other words, by making certain gifts during your lifetime, it will help you to reduce the liabilities, as these will be removed from your estate completely. Another client has rang me recently who's a business owner, and he wanted to know how he will be affected by these rules. Now, as a business owner, you will qualify for what is known as business property relief, whereby your enterprise can be passed down to your family members free of inheritance tax. However, even when this is the case, its value will be included in the value of the estates for residential nil rate band purposes. So this often exceeds the £2 million mark, placing you outside of the exemption. So in conclusion, these revised rules can be a minefield, and some of the traditional tax planning arrangements that were made in the past may well be redundant now. With revisions already in play as of April and further changes being phased in over the next 3 years, now is the right time to set about financial engineering to protect your wealth. Your main residence is now more tax efficient and doesn't attract any capital gain, and your pension can also be passed on tax-free. If you've got stocks and shares, for example, that are wrapped in an ISA, although these are not liable to any income tax, they can be included in your estate and liable to inheritance tax. Therefore, it's well worth using up pensions before looking at these. Well, that's it for today, and that concludes our episode on inheritance tax. I hope you found it both interesting and enjoyable. If you've got any further questions, feel free to give me a call. I'm on 0207 435 0420, or you can drop me a line, chris@ashmoreresidential.com, or of course you can pop in to see us. Our office is just on Heath Street, 50 metres from Hampstead Tube. Thanks for watching. Bye for now.